due diligence, private placement offering, private placement memorandum, and term sheet. Private placement offering. It is the sale of securities to a relatively small number of select investors as a way of raising capital. For a private company, entrepreneurs understand that raising capital is the ultimate tool to experience real growth for their companies. So, for whatever reason it may be, if a small company avoids the opportunity of going public, this is the alternative way to raise that specific amount of capital in a short amount of time. Unlike the IPO process, private placement offerings do not have to be registered with the Securities and Exchange Commission, and also the financial information is very limited to what is disclosed to the investors. So think of it as a informal way of raising capital. So an average investor should really take the time to take the reasonable steps in order to minimize his risk and understand exactly the type of deal that's being negotiated. Typically, since venture capitalists and investors are always searching for opportunities, sometimes after hearing a private placement offering, this can indicate a flag for them, which can trigger in mind that these small companies may be exhibiting high growth potential. So, for example, an investor may be searching for small companies with the belief that it plans to go public. So, with media news of private placement taking place, this may indicate to investors that the company is steering up some traction and it's worth investigating into. In addition, private placements are also a way to attract venture capitalists and hope that that business will go public soon, or the company will sell for multiple 10 or 20, depending on the industry that it's in. As with private placement, while the regulations of private placement offerings are less than the IPO process, there are still some legality issues that must be examined closely with private placement offerings. In a private placement transaction, the company relies upon the Regulation D, which is basically a way to meet the Security Exchange Commission rules to be exempt from federal security registration requirements, which in turn can expose risk to investors. The rules and their claims are as follows right here. Rule 504 states that sometimes the investment is referred as seed capital exemption, which provides the offer up to 1 million of securities within a 12-month period. Moving on to Rule 505, it states that the company is basically not subject to disclosure requirements and may sell to any number of prospective investors, totaling up to $50 million in a 12-month period. Finally, Rule 506, it provides the two methods of conducting a securities offering, which is exempt from registration, and that's Rule 506B and Rule 506C. Rule 50B has been a long-lasting rule, while 50C has recently been added in the year 2013 to supplement the statutory mandate under the Jobs Act. As any entrepreneur and investor, they know that they'll be engaging in a transaction that involves a substantial amount of money. It is important that they understand the process to take the reasonable steps in order to minimize their risk and to successfully make the deal happen. So, with due diligence, as defined, it is an investigation of a business or person prior to signing a contract or an act with a certain standard of care. So prior to signing a contract, especially with a private placement offering, investors need to take the initiative to go above and beyond and study the company, study the industry, and understand the external and internal factors that underlie within that company and any risks that may be associated with it. And then also, one may want to double check with uh, the company or the investing firm to check their credibility and make sure that the opportunity seems legit and the research that has been conducted has been verified, and everything is a go. This leads to the private placement memorandum. This is a legal document stating the objectives, the risks, and the terms of the investment that are involved in private placement. Um, Such contents include the financial statements, management information, a detailed description of the business. So this is where I was talking about the risk, the both external and internal risks that are associated with the business. So a very detailed description of the business could even include a written plan of their business plan as far as their marketing strategy and their position they're taking. And now essentially next is the term sheet. So here is a sample of how a term sheet or the anatomy of a term sheet may look like when making these type of investments. An anatomy term sheet will basically break down the entire structure of how the investment deal will go in place. So everything from the credit rating, from the initial valuation of the issuing stock, all the way to the payoffs. It includes basically the structure that an investor should definitely look at, and also plans the objectives of the company, how they plan to utilize these proceeds and pay back the return. Thank you for watching.